Hi there, Serial Trader here. Let's get straight to it and address the bloodbath that we've seen this week in the market. And we'll start off with the wave chart here on SPX. Alright, so since my last video, I attempted a small long there on ES. And I got stopped out, and good thing I honored that stop because it just kept plunging another couple hundred plus points from that area. But let's just do a quick overview before I get to the trading side of things. Quick overview of kind of where we're at here, big picture. And I'm thinking we have a large degree wave 3 that completed in the fall of 2018 there. And this is currently my interpretation here, is that we had an initial ABC down for A that bottomed in December of 2018. And we've done this large A, triangle B, C up for that larger B wave. Okay, larger B wave. And now we're coming down in a larger C wave, potentially for a running flat or an expanded flat or even a larger triangle. Again, not enough information to know exactly which pattern we're working, but so far we got a 3 down, we got a 3 up to a new extreme, and now we're looking for either another 3 down or 5 down to potentially complete a larger multi-year wave 4, and then potentially set the stage for another multi-year wave 5 up, large degree wave 5 up. But certainly right now the focus, don't worry about that large degree wave 5. That's nothing to be thinking of at the moment. What we need to look at here is the shorter term price action. And okay, so I've basically framed what I want to frame here, big picture. But just before I go over to the shorter term time frames, this is still the daily chart. So we're as oversold as we've almost ever been. It's certainly right up there with some of the most oversold conditions you'll ever see. Even today, as of the nice intraday reversal off the lows, the daily RSI is sitting at 19. I believe it was around 15 or 16 at one point during the day near the low. So that's very extreme. So certainly nice daily oversold conditions. We know previously those daily oversold conditions have produced significant bounces. They weren't always a lasting bounce, but they were certainly tradable. And I expect something similar in this situation here. And okay, we'll go to the shorter term time frame to kind of examine some things. Oh, but before I do that, you see all these gaps. I believe it was 4 gaps I pointed out in the last video. Well, we've now addressed all those gaps in very short order. That's definitely the fastest drop I've ever personally observed, and I think it ranks up there in the history books. So this is not just an average pullback. Let's just keep that in mind. But nothing goes straight in one direction, whether it be down or up. And in a market that just couldn't go down for any reason at all, now we've just gone straight down. You better believe there's going to be some sort of relief rally, oversold rally here. I'm definitely a big believer in that, and that will likely set up for an excellent short entry for that next leg down, whether it be a third wave or a C wave. It doesn't really matter. The likelihood of, once we bounce up here, getting another leg down to test or take out those lows, very likely. Okay, so let's go with the short-term time frame. And this is the hourly chart. So I've made an attempt here. I mean, this is very fast action, but you can still get some waves and subdivisions out of it. A lot of gaps, obviously. So I got a 1, 2, 3, 4, 5 down, pending further confirmation. But I think there's good reason to believe that today's low is a tradable low. And that's for either a larger A down or 1 down. Now we are going to be anticipating a rally up here for either a B wave or a second wave. And I've just gone ahead and put some Fibonacci retracement levels up there. And definitely keeping your eye on the 50% to 61.8% retracement levels. But based on past action, I mean, you could even rally all the way up to the 786, get close to 3,300. I'm not saying it's overly likely, but just I wouldn't be surprised if it did. Especially if you start seeing huge, panic reactions from central bankers, and they start basically initiating government programs to pump up stocks and that sort of thing. I mean, China's already done it. Their market recovered almost all of its pre-coronavirus decline because basically the government intervened. Now, whether that lasts or not is another story, but they still did it. So I wouldn't discount... you got to think of the political motivations here. Trump knows that if this market doesn't hold together, he's likely not getting reelected. So he's going to get on the phone to all sorts of people and likely, at least encourage a pump, if not outright force it. Now, I'm not saying that holds. That probably gets us our B wave or second wave, but then that's the opportunity to get short again. Right now, though, I think the overwhelmingly likely play is to position long here for a sizable rally. It could be a multi-100 point rally just to do a typical fib retracement. So let's just focus on that. Now the thing is, and you could see some bullish divergences here just on the hourly RSI. You could see we kept stabbing lower in price, but hourly RSI kept making slightly higher lows and now starting to come off that oversold condition. So certainly the ingredients you want to see for a tradable bottom, some short-term divergences there. But okay, so what if we do have a tradable low in place, which I'm proposing here today? What should we look for in a B wave or a second wave? Well, unfortunately, there's a lot of corrective patterns that could play out. We could just do a simple ABC zigzag up like that. That could certainly happen. We could do a flat. So we could do an A up, a B down, and a C up. And that could be either a regular flat, an expanded flat, or a running flat. But basically come up, come down, make a near double bottom, then come up again, make a near double top. Or in the case of an expanded flat, make a new low, and then make a new high in the C. Or in the case of a running flat, make a new low in the B, fail to make a new high in the C. So that's that potential. We could do a triangle B wave. If it's a second wave, it won't be a triangle, but we might do a triangle B wave where you got an A, B, C, D, E. Okay, and then you fail and come down in that C wave. This is in the B wave scenario. Remember, a triangle cannot form in the second wave position unless it's part of a larger structure and the triangle just interrupts two other waves. So there's that. Or we could do something more complex. We could do a double zigzag, WXY. Less likely, but still possible. We could do a triple zigzag, WXYXZ. So we just don't know what kind of corrective wave up there's going to be, but we have a good idea that there will be a significant move up. Just not really sure how that's going to form as far as the pattern yet. We just don't have enough data to know that. But we do have a very convincing, to say the least, impulse wave down for either an A or one, and now we're expecting that corrective wave up. So until there's more data, I certainly can't analyze the corrective wave up and gather any information off of that. But right now the play is super oversold, signs of a nice reversal today. We'll get to that on the other charts. And very convincing 5 waves down, arguing for some sort of 3-wave corrective structure to the upside. Okay, so that's SPX, the wave patterns. Now let's go to the Thinkorswim candlestick chart. So we absolutely destroyed all these moving averages. 200-day moving average, like a hot knife through butter, didn't provide any real support there. Maybe intraday it slightly reacted off of there, but nothing on a daily closing basis. But today we've got kind of an exhaustion gap down and multiple gaps here. Here's another thing. So as I pointed out before, almost all gaps get filled eventually on these major indices. And we've seen that now. We have all those gaps beneath us. They've all been filled very quickly all this week. Well, now we have several gaps above us, 3 gaps here. Now, I'm not saying we fill this final gap, although again, I wouldn't even be surprised, especially with some executive interventions in the market. But I suspect we have a very good chance of filling at least these two gaps here. Again, because eventually all gaps tend to get filled on major indices. I don't think this will be any exception. So we have an exhaustion gap, and we have a kind of a bullish hammer reversal candle. Certainly a change in character today. Made new lows, but closed up near the high of the day and closed well above the open and all that sort of thing. So this candle stands out. We didn't have any kind of bullish action on the way down. Now we finally do. We're in the oversold condition on this oscillator, just starting to curl up, obviously. So potential bullish reversal candlestick in the extreme oversold condition with mature looking 5 waves down. That's a very compelling technical setup for a big relief bounce here. Now that's the daily. If we look at the weekly, this will be one of the nastiest looking weekly candlesticks you could probably ever find on this chart, going back as far as you want. And you can see we went right through that 50-week simple moving average. The 200-week moving average is down here, and you can see in the past, let me go back here far enough, you can see in the past throughout this rally we've been in since 2009, we had a reaction off the area here of the 200-week average in, let's see, 2016, and also here in the bottom of 2018. So before it's all said and done, after we do have our relief rally up and the next leg down, I expect some interaction with the 200-week average once again. And that's currently just over 2,600, so keep that in mind. Okay. And let's see here. Oh, actually, you know what? I just do want to, before I switch over, I do want to quickly go back to the trading view chart here. And what was I going to point out? Oh, yes. So in the last video, I was showing potential retracements for a more bullish potential here. And you can see, not only did we go through all those retracements just this week, we actually invalidated by getting below the low there that we made in October. So that potentially bullish interpretation where we had an impulse wave up when we were correcting that for another impulse wave up, that is gone. That's invalidated. So you can throw that away. But I did another retracement here, and pulling off the December 2018 low, so treating this entire move as it should be, as one structure, and going up to the high here, I did some retracement levels, and let's get rid of the 382, we went past that already. So we basically reacted right around the 50% retracement level of the entire move up from the December lows to our recent highs there. And also this corrective trend channel that I've drawn, the ABC trend channel, slice through that. So again, when you break a trend channel, obviously we're getting a reaction off that 50% retracement. But when you break a big trend channel like this, very common to go up, rally up, and then test the underside of that channel, which was formerly support, to have a now act as resistance. And that would also be in line with our expectation of a corrective rally up after this initial impulse wave down. So kind of a throwback to the bottom side of the channel to active resistance, where it's formerly support. So I just thought I'd point that out. But yeah, I just thought it was interesting. Did get a reaction off that 50% retracement off this entire move. Just thought I'd point that out. But yeah, right back to the Thinkorswim candlestick chart. Okay, we've already examined SPX. Now let's look at the Dow Jones Industrial Average. Similar situation, although the Dow even more obliterated relative to itself than the S&P. You can see this is the October low here in the Dow, and I mean, we just went right through that, whereas the S&P reacted off of it. So the Dow showing some relative weakness. We actually almost got down to the June lows for the Dow, which we certainly did not do on the other indexes. Sorry. But nonetheless, the Dow still is in a similar situation, extremely oversold. We did a bullish hammer reversal candle today, and if the S&P bounces, then certainly the Dow will bounce relative to itself as well. And very high correlations right now. Basically, any chart you look at, by and large, you're going to see that the market had an extreme effect on it in most cases. There are some exceptions, but not very many. Okay, Dow obviously oversold condition on the oscillator, starting to curl up. Let's look at the weekly candle on the Dow. And that is very ugly. And the Dow, I'm sure it'll eventually play with its 200-week simple moving average before this is all over. Oh, actually, yeah. So quickly go back to the SPX chart. I did want to show the monthly since we just ended the month, ended the trading month of February. And let's do that. So monthly candle, interesting here. So we did have a monthly inverted hammer in January. And that was a nice reversal signal, although the high of that candle didn't hold. But in retrospect, it was still a signal of something to come, because obviously this month ended up being extremely bearish. And we've closed below the monthly T line. And this is obviously a very strong bearish candle on the monthly. And typically, once you get a bearish candle on the monthly, I'll just point this out, even just looking back here, once you get a significant bearish candle on the monthly, yeah, you get a relief rally, as we did there in 2018. But it's not all done. Once you get a red monthly candle, that's not the end. It's not the bottom. You get the reaction, and then you go down again, and then you maybe start to look for a more meaningful, major bottom. So ugly monthly candle. Before it's all said and done, we likely do go lower. Just so I point that out. Okay, so back to the Dow. I believe I showed the Dow's weekly and daily candle. We'll just quickly peek at the monthly on the Dow as well. Why not? And very similar looking to the S&P, so nothing really to stand out there or mention. Now the Nasdaq Composite. Nasdaq Composite, again, it's obviously going down a lot, but relative to its own chart, it's still stronger than SPX or the Dow. You can see this is the October low here in the Nasdaq Composite. And we didn't even get anywhere near testing the October low, whereas we did break it slightly on SPX and just obliterated it on the Dow. So relative to its own action, the Nasdaq has still shown strength. The Nasdaq also bouncing significantly today off its own 200-day simple moving average. Again, that's a moving average that we've already destroyed on the other two indices. And the Nasdaq actually closed slightly positive today. You can see this huge intraday reversal. And if we went a little farther into this prior candle, we actually would have had a piercing candle, but this doesn't go far enough. Despite being a huge reversal, it's not technically a piercing candle, but it is still a fairly bullish reversal candle. Also, obviously oversold on the oscillator, starting to curl up on the Nasdaq Composite. So everything is in line for a major bounce here. Weekly on the Nasdaq, see the Nasdaq also reacted nicely off its 50-week simple moving average, something the other two indices did not. So the Nasdaq relatively still stronger to its own previous price action. Let's look at the monthly here on the Nasdaq Composite. Okay, so the other two didn't actually have an engulfing candle, although it was certainly a bearish candle. Nasdaq has a legitimate monthly bearish engulfing candle, so, and a huge upper shadow. So we have a legit sell signal candle, bearish engulfing on the Nasdaq Composite monthly. Again, when you get those monthly sell candles, it doesn't just end there. After that reaction bounce, you do look for a lower price after that, just based on previous price action and also based on the implications of the candlestick sell signal. Okay, so that's the Nasdaq. Gone through that. Now let's go look at the VIX. Now in the VIX, another reason why we have a fairly convincing tradable bottom today. VIX went very high, went to almost 50, but a huge intraday reversal for the VIX, and you could call that a big inverted hammer in the overbought condition on the VIX. So that certainly complements a major reaction rally in the cards here. Now, if we look at the VIX as far as, well, okay, we got to 50. Is that really high on the VIX? Well, it is. Let's just do a little look back here. Okay, so here, that volatility panic we had in, I believe it was February of 2018, we got right around to that same level here. So that's certainly a high level on VIX. And where was this now? This was 2015. And that marked a major panic at the time. That was 53. So once you get into that almost 50 area, I mean, that's marked some pretty important tradable bottoms, not necessarily ultimate bottoms, but tradable bottoms. And we did that today. And more importantly, we did that today and reversed sharply and did a bearish reversal candlestick. So VIX in the overbought condition on the oscillator, starting to come off that overbought condition, big reversal candlestick. So VIX is saying, hey, that's enough for now. It's time to go higher, at least periodically or temporarily. Now, going to the VIX VVIX tool, another thing I like to look for is a divergence to mark some sort of pivot. Well, VIX made its high today, but then later on in the day, when SPX was testing its lows, not making new lows, but testing its lows, it did pass the test and start rallying. VIX was unable to make a new high during that time. VVIX, however, made a higher high. So you have a nice divergence between VIX and VVIX. The ultimate highs diverged there. One made it, one didn't. That's the first ingredient for a potential buy signal. Next ingredient is getting below the red moving average on VVIX, and then of course getting back above the blue moving average on SPX, which is quickly coming down to catch up with this vicious move down. Currently around 3,100 though. So no buy signal yet with this tool, but by the time you get a buy signal, we could already be up 150 points or something. So I don't want to wait for that, but certainly the early ingredients for the buy signal are there. Now, as far as trades, I got multiple things open. I have some SPX calls, SPY calls, ES longs on the futures, and as of today's close, I'm in the green on most of that, but spread around different accounts, etc. But yeah, basically, you don't have to do anything too fancy here. Just go long. Doesn't have to be on the indices. Pick any major favorite stock. You can go look at Apple stock, Amazon stock, whatever. Just something that you know is going to trade fairly correlated with the market. And I would say go long, stop below today's lows, and try and ride this relief rally up. And then once we have a corrective pattern and it looks mature, that'll be the time to put on some bearish positions to look for that next move down. But until then, I think the play is to play along here. You got to trade it. Don't buy long thinking you just bought the bottom for the next 5 years. I highly doubt that. Play along thinking you just bought the bottom maybe for the next number of weeks potentially, or certainly number of days. All right, that's good for now. We'll see what next week has in store. Should be interesting. Serial Trader signing off.